And this is Money Mind on CNA938. Gold is one of the most highly regarded and traded commodities in the world. But how much do you know about its true value and significance, especially to the financial markets?
And what is the outlook on gold as the world continues to face a highly uncertain future brought about by the COVID-19 pandemic? Well, to speak about this, we have on the line Luke Chua, who is the Chief Operating Officer of BullionStar. The organization operates metal dealerships, meaning it provides services including selling and buying precious metals like gold and silver. Now, welcome to Money Mind, Luke. Tell us more about the demand for precious metals in the current climate, especially with COVID-19 impacting markets worldwide.
Thanks for having me, Willin and Stanley. When I look at the activity in the precious metals markets now, I see a continued strong uptake in the investment demand for gold. I think silver is still trying to play catch up to gold. Now, platinum is more of an industrial metal, and the weakness that we've been seeing for the past few years is a result of the decline in the industrial use of platinum. For example, the decline in the state of the automotive industry. But for the investment demand for gold specifically, globally, it's up about 13% since the start of the year. So this means that private individuals as well as institutions have still been accumulating gold since the start of this year.
Right.
Also, central banks have continued to amass gold this year, and this marks the 11th consecutive year since 2009 that central banks have been net buyers of gold. So from what I'm seeing, the investment demand for gold is perhaps the highest it's been in the past 8 years.
So whenever there's a downturn where the economy is not looking too good, looks like it's a safe haven where people would flock to where it concerns with gold.
Yeah, absolutely.
Why should we buy gold? Because investors like Warren Buffett aren't fans of it because he says it doesn't pay dividends and you've got to pay other people to protect it and store it.
That's a good question, Willin. In terms of how I think about it, I think we need to look at where we are in the current financial and economic state that we are in. So this year, it's been a horrible year from a humanitarian perspective and an economic perspective, and we still have 7 more months until the end of the year. Our Prime Minister, Mr. Lee Hsien Loong, he said that he expects the fight against COVID-19 to be a long-drawn one with financial and economic repercussions given the shock to the economy, not just in Singapore, but globally. And the shock to global trade is unprecedented. We've not seen numbers like this before. GDP numbers across the world are being revised lower and lower, and employment is rising globally, which is a huge challenge for every nation. So to resuscitate the economy and to support jobs, what we're seeing now is that governments around the world will need to inject liquidity into the system, which in most cases would mean printing more money. Now, the Federal Reserve announced in April that they will be injecting about $2.3 trillion into the US economy. Our Deputy Prime Minister, Mr. Heng, announced yesterday in the Fortitude budget that he would be injecting another 33 billion Singapore dollars from our reserves to support jobs. Now, all nations are increasing the money supply and the fiscal spending during this pandemic to provide aid to the economy. The worry now for most developed countries is not actually inflation, but debt deflation with the consequence of a halt in economic activity. So the risk is that businesses, real estate, financial assets, they lose their value relative to the debt used to finance them, which could lead to increased bankruptcies and a credit crunch, which means a breakdown in trust in the economy. So this is the immediate challenge. Now, once we have enough liquidity in the system to get economic activity up and running again, then perhaps we need to worry about inflation. But you see, gold protects wealth in both of these scenarios. So during a debt deflation, the biggest worry is counterparty risk. For example, is the company whose stock or bond you bought going to go bankrupt? Gold, on the other hand, does not have any counterparty risk, and therefore it protects your wealth. And gold has historically performed well even in a deflationary environment relative to other goods, because people start to hoard gold during a deflationary environment precisely because there's no counterparty risk. Now, in the case of an inflation or perhaps a hyperinflation, where prices of goods, increase drastically, primarily because people are losing trust in the local currency, And if it gets out of hand, then the value of that currency gets destroyed. Now, throughout history, this has happened countless times through different civilizations, which is why we don't see many of the currencies that were present even 100 years ago still exist today. But as mentioned earlier, gold, because it has served as wealth protection during these times of transition, and it's protected well for over 6,000 years. That's why the value of gold is still present today, and I think that's why investors need to still keep their eyes on gold, especially physical gold, because of the property that there's no counterparty risk, and it provides a hedge against the risks inherent in the financial system. Now, of course, the two scenarios that I've talked about are the end state, and we hope that never happens because it's terrible for the entire society. But just like car insurance, you have to buy it for protection, not because you're hoping to get into an accident. So gold serves as wealth insurance in the scenarios that I just talked about.
Okay, the benefits that you mentioned about gold, is this only with regard to physical gold as opposed to paper and digital gold?
So paper and digital gold, they have different objectives. Okay, so with paper gold, you are exposed to the price of gold, and if your objective is to buy low and sell high, that paper gold achieves that objective for you. However, if you're looking at gold as a way to preserve your wealth and hedge against the risk of any sort of financial crisis, then physical gold is the only way. And the reason for that is because with paper gold, there is still counterparty risk. How you go about buying paper gold would be, going to your online broker and perhaps placing a trade. Now, what that means is that you have a paper claim on gold that your online broker needs to honor. The question is that in the event of a crisis, will your online broker be able to honor that paper claim? Physical gold, on the other hand, has no counterparty risk. It's in your possession, so therefore it protects you against a risk of the risk associated with a crisis.
We are hearing from Luke Chua, who is the Chief Operating Officer of BullionStar, and we are talking about all that glitters, it being gold. If you've got any question for Luke, we welcome your calls through to 669-11938, or you can text us at 669-11938. Now, Luke, what are some important questions that potential investors should be asking themselves if they want to consider investing in gold?
I think firstly, investors need to ask the question, what is my purpose for wanting to invest in gold? And what sort of investment time frame am I looking at? Am I looking to trade around the price of gold, or am I looking to buy and hold for the longer term? Or am I looking to buy gold to protect my savings against the risk of a financial and monetary system breaking down further? Naturally, some of these answers to these questions might overlap. For example, owning physical gold exposes you to the possibility that the price of gold could go higher, and at the same time protecting you from, let's say, the repercussions of a financial crisis. But what's very important to understand is that all gold is not created equal, as I touched on before. So there's paper gold and there's physical gold. So you need to decide what sort of investment objectives you're trying to achieve, and then pick the correct product accordingly.
Luke, could you explain to us how we can go about buying the physical, paper, and digital gold?
Okay, so with paper gold, you could buy it from an online broker. It's some brokers are they structure it as a currency trade. So much like how you could do a currency trade with US dollars and Sing dollars, you could do the same with paper gold denominated in a currency of your choice. For example, gold denominated in US dollars or gold denominated in Sing dollars. And of course, if the price of gold appreciates relative to your local currency, then you would have made money and you can close that trade. With digital gold, what's happening now is that some companies are taking the technology of blockchain and applying it to gold, where they might hold some form of physical gold stored with a custodian, and then they offer a financial product on blockchain which allows you to buy into that reserve. But ultimately, that still just gives you the exposure to the gold price, but no ownership over the actual gold itself, because you can't withdraw that gold and take it into possession. Now, physical gold would have to be bought from bullion dealers like BullionStar, or from some banks. It's actually a very straightforward process where you would go into a bullion center, or you might go into a bank and request that you would like to purchase some physical gold, and depending on the amount in which you are looking to spend, you could choose different denominations of physical gold. For example, a 1 kilo gold bar or a 100-gram gold bar, and then make your decision from there. When you've transacted, you simply pay for the transaction and take the physical gold into your possession. Of course, if the amount is big and large, and it's not feasible to then store these gold bars in your home safe,
Yeah, you
there
got to
are
think about
also
security as well.
Yeah, correct. So there are solutions where you can store these gold bars or gold coins in vaults, private vaults that are outside of the banking system, and that might be a way to protect yourself when the situation calls for it.
Now, there are some rumors that the gold market is manipulated. What are your thoughts on this information?
I think that, firstly, the value of gold and the price of gold are two different things. So the price of gold can be manipulated, and has been through various means, because it's dependent on the currency in which it's priced in at any one point in time, and prices change, second by second. The value of gold, however, is precisely that it protects against manipulation in the markets, and it kind of needs to be understood over a much wider and longer perspective in light of its role as a wealth preservation asset. So gold's value actually becomes increasingly important as the risk of calamity in the financial markets becomes greater. So what do I mean by this? If we look at history, financial and monetary systems come and go over time, but gold has lasted over 6,000 years. And as I mentioned earlier, if you look at any of the currencies that are still around today, like the US dollar or the pound, which existed maybe 100 years ago, these currencies have actually lost 99% of their purchasing power over this short period of time, which means something that maybe cost a couple of cents 100 years ago could easily cost a couple of dollars today.
Now, Bloomberg says Europe hedge fund managers Crispin O'Day think that governments may ban private gold ownership, and that's if they lose control of inflation in the wake of the coronavirus crisis. If you could break this down for us, helping us figure out that link between inflation and gold ownership.
That's a good question, Stanley. Firstly, I would point out that O'Day himself has increased his gold position in his fund to around 40%. That's a big number. How many hedge funds in the world actually allocate 40% of their entire portfolio in gold?
Right.
Now, on the topic of banning private gold ownership, we actually have a blog post titled Gold Confiscation, Could This Happen Again? So this was published in March this year on our website, and it discusses the possibility of a repeat of the 1933 gold confiscation that happened in the US. Now, the gold confiscation that happened in the US was an attempt by the government at that point in time to prevent the hoarding of gold. What I would say, though, is that it only had a compliance rating of about 50%, with the other 50% of gold actually having gone into hiding, despite the threat of getting fined or imprisoned for hoarding gold. So the effectiveness of the confiscation, even back in 1933, was arguably poor. Now, what about our present day? I think that banning private ownership of gold is highly unlikely in our present day, because back in 1933, the world was still on a gold standard, where currencies around the world, they were backed by gold or some form of precious metals. So that meant that gold was the foundation that everything else drew its value from. But we know that this isn't the case anymore, and the gold standard was abandoned. And this means that the hoarding of gold by private individuals does not actually act as a constraint for central banks and governments anymore, because now they can increase the money supply for financial and economic expansion reasons as they deem fit. Furthermore, I would also argue that, if a nation were to nationalize gold, it would actually cause the citizens of that nation to further lose faith in their national currency, which would then be detrimental to the monetary system of the nation. So, I would encourage anyone interested to Google the keywords gold confiscation, BullionStar, to try and find out more.
All right. Well, on that note, we have to end this interview here as we've run out of time. But thank you so much for speaking with us, Luke, and sharing your thoughts on gold. That was Luke Chua, Chief Operating Officer of BullionStar.
Before making any decisions based on the information in our program, please consult your own financial advisors to take into account your investment objectives, financial situation, and individual needs.